ESG investors pan politicized proxy advisor proposals. The Shareholder Rights Group has written a lengthy rebuttal to proposals from the U.S. Securities and Exchange Commission, SEC, that would unravel long-embedded investor protections. The letter, dated 6 January 2020, is the first in what the group describes as a series of substantive comments on the rulemaking proposals on proxy advisors and shareholder proposals. SEC proposes higher thresholds for shareholder resolutions under the proposals put forward by the SEC. Proxy advisor recommendations would be treated as solicitations, subjecting them to increased liability exposure and allowing issuers, but not shareholder proponents, the right to review and comment on final proxy advisor recommendations prior to publication. Currently, shareholders have to hold at least $2,000, £1,540, worth of shares to submit a proposal. This threshold would remain in place, but a proposal could only be submitted after they have held the shares for 3 years. If the shareholder wanted to submit a proposal in their first year, the threshold rises to $25,000, dropping to $15,000 in the second year. Additionally, if a proposal fails to garner enough support, the levels at which it can be resubmitted in subsequent years would rise sharply. The SEC, which described the changes as a modernisation, said that they could save around $70 million and reduce submissions across the entire range of Russell 3000 companies by 37%. A claim the Shareholder Rights Group describes as illusory. Politically motivated diluting the existing shareholder proposal process further erodes investors' rights and protections to engage on material ESG issues, which may pose significant risks to investors and companies alike, says Lauren Compere, Managing Director and Director of Shareowner Engagement at Boston Common Asset Management, which is one of the Shareholder Rights Group's 15-member firms. Speaking to portfolio advisor sister publication Expert Investor, she says the proposals from the SEC are in line with other moves the current administration has taken to unravel long-embedded investor protections. She describes the motivation behind them as strictly political in nature. Investor engagement with issuers on ESG matters through the shareholder proposal and proxy voting process are critical components of ESG integration. Integrating ESG factors has become a necessary part of investment. In the context of market volatility, climate changes and regulatory intervention, ESG factors offer an expanded set of tools to address unmet investment industry needs in accordance with fiduciary duties. In 2018, when the SEC first outlined its review of proxy advisors, Morningstar complained a group of corporate lobbyists were shaping the debate while posing as a grassroots campaign representing retail investors. SEC accused of discouraging engagement. For more on this story, visit the news article link.